Welcome to the Halftime Report. I am Frank Holland in for Scott Wapner, front and center this hour, riding the record rally. Stocks soar to new highs as the Fed goes big on rate cuts. So what's the playbook now as the Fed signals even more rate cuts coming? Our investment committee is standing by to break the entire thing down. Joining me for the hour, we have Stephanie Link, Jim Liebenthal, and Kevin Simpson. But first, we get a quick check on the markets, and we're looking at intraday records. Also, obviously, we're on rally mode right now. You see the graphic right there. Looking at the Dow right now, up 1%, more than 400 points, hitting a new intraday record. Similar story for the S&P, up over 1.5% new intraday record. The Nasdaq up 2.5%, about 3% away from its all-time high. And that is where we start. Jim Liebenthal, that's where we start. Rally after the big Fed rate cuts. It was 50 basis points after all. In your mind, what do you do now?
Well, first off, I was pleasantly surprised by the 50 basis point rate cut. I wanted that. I didn't think they would do it. Good for them. Both in action and word, the Fed is saying they will not get behind. Good. In terms of what you do now, frankly, this is where we think the broadening of the rally is going to continue. There's a lot more left to run in that regard. We've been overweight to small caps all year. We have a healthy allocation to cyclicals in the portfolio that I run. That includes overweights to financials, industrials, materials, and energy. I'm not, folks, saying that you should go ahead and sell your technology stocks. I'm just simply saying that given the price levels for those other cyclical areas relative to the growth prospects that are enhanced by a Fed that says not going to get behind the curve, that's where you want to have your money. I should point out, I do want to be honest, show some integrity. Yesterday when we spoke, Frank, I told you I was trimming some large cap names, large cap tech, Google and Oracle. At the time, I said I'm still very bullish on them. That was portfolio management. Nobody should take the wrong message from those moves. I am long and strong. My cash level is 5%. It was about 2% before yesterday. I think as we get up to the election, you're going to see moments that are volatile, and whether that's in the markets as a whole or individual names, I do expect that by the end of the year, that 5% will be back in the market. But make no mistake, I am long, strong, and optimistic as ever.
You know, Jim, we're going to get to that anyway, but since you mentioned, I'm looking at Oracle right now, up 1%, Alphabet up also as well. The tech sector itself up really big. The leader today, do you regret, I know it was just a trim, but do you regret not just keeping that money in the market or maybe even adding to your position?
I don't, because both of those positions are 5% weighting, so I still feel good. The only sort of thing that feels uncomfortable is, oh, geez, you know, somebody who isn't aware of my portfolio positioning and is listening to me today or yesterday saying, oh, look at Liebenthal, what a dummy, he sold something yesterday. I wouldn't say that, folks. I would say, again, 95% invested. A lot of the stocks that I own, whether it's technology or cyclicals, have been doing very, very well this year. I'm having a good year and I'm feeling good.
All right. Steph, we're going to come over to you right now. I mean, where are you looking to put money to work today? The thought was after the cut, the cyclicals would take leadership, but today it's tech and communication services.
I think it's a lot of different sectors, Frank, but I too was very surprised, like Jimmy, that the Fed did 50 basis points, just because the economic data has been pretty good. Just this week alone, we got better retail sales, higher revisions to prior month. We have had much better housing starts and permits are a leading indicator. We had 2 regional manufacturing series that showed better than expected growth. And of course, we had a 4-month low in weekly initial jobless claims. You add it all up, you're running 2.9% according to Atlanta Fed Tracker. I don't know if it's 2.9% at the end of the day, but it's 2.5%. And on top of that, you have a Fed that double cut. That is a very big positive for earnings. When you have good growth and you have low inflation and you have cuts coming, more cuts coming, good for risk assets, good for earnings, good for cyclicals. And cyclicals, there's parts of tech that really are very cyclically driven. The semi-cap equipment. I've been adding to Broadcom. At the same time, I've been adding to energy, because if in fact we are going to see demand in the economy stay strong, you're going to see better commodity prices, in my opinion. And at the same time, you have a weak dollar that should also help the commodity picture. So I want to be in parts of tech, but I also am in many other cyclical parts of the market: industrials, materials, discretionary, housing. I think all of these things will work between now and the end of the year, and you want to use the volatility from any election issues to be buying those sectors.
You know, as you talk about energy stuff, we were just showing it just right there. Oil having its best day in just about a month. Kevin, coming over to you. Surprised at all after a 50 basis point cut that we're seeing utilities and consumer staples lagging today? Utilities in particular are supposed to benefit from the rate cuts, and also just want to get your take on the Fed going big. That's the way a lot of people are seeing it.
Yeah, I mean, I think the expectations were a 50 or 25 basis point rate cut was going to be a coin flip. We got to 50, that's good. Utilities have been beneficiaries, real estate have been beneficiaries in anticipation of it. Yesterday, in the last half hour, you saw a little bit of sell the news, and we'll probably get more of that. It's kind of like wash, rinse, repeat, sell the news, digest it, sell it, digest it. You also get to play a lot of Monday morning quarterback. Did they go too high? Did they wait too long? What's going to happen next? But the Fed had to cut rates. They talked a lot about the labor market, but I think it's more about growth. And the other thing that we don't talk about that much is that for 14 months of holding tight, that's still becoming much more restrictive as inflation's coming down. So real interest rates become higher even without the Fed doing anything. So a proactive pullback yesterday, I think, was the right move. So many people were critical of them being late to the party and tightening. We'll get the same Monday morning quarterback here, as I mentioned, but I think they deserve the benefit of the doubt.
I want to bounce something off of you guys. Friend of halftime, Brian Belsky from BMO, he actually just raised his S&P price target today, moved it from 5,600 to 6,100. I'm going to read part of what he had to say with that. He said, "We believe the index will finish the year at higher than current levels. Therefore, with the index trading at roughly our current target, we're raising again from 6,100 from 5,600, or about a 9% increase, much like our last target increase in May. We continue to be surprised by the strength of the market gains and decided yet again that something more than an incremental adjustment was warranted." Jim, your take on this? I know a lot of times we talk about these S&P price targets. They're not necessarily that meaningful except for sentiment, but this is pretty strong sentiment, a 9% gain from here.
Yeah, I think you just phrased it exactly right. I wouldn't focus on the exact number, but the sentiment that's implied, which is that we're going to rally. I think it's very strongly likely that we're going to rally into year end and set new highs. Now, again, volatility along the way. We got a lot of stuff going on, whether it's a presidential election, the Middle East, I mean, you name it. There's a lot of stuff going on. All that said, it's not just sentiment, but it's how do you look underneath the hood of, okay, if the S&P 500 is going up, does that mean you just want to buy spiders and call it a day? We don't think so at Cerity Partners. I mean, we're overweight small caps, and that's where we see a bigger return. We're as optimistic as Brian is, but we see a much bigger return in small caps than in the market overall.
Kev, your take? Belsky raising his S&P price target. Again, I think he and I are both agreeing. It's more sentiment than the actual number that he's putting to it.
Yeah, I'm glad I don't have to give a market call, because it's sometimes backing into it with basic math makes you scratch your head a little bit. If we get $277 for 2025 S&P earnings, what multiple does it take to get there? 21, 22, 23. These are admittedly higher and much higher than traditionally we've been accustomed to. But when you want to see a market that is moving higher and it wants to go higher, you don't want to fight the tape. So I think for stock pickers, even more so, we've got tremendous opportunities here. We'll see air pockets. We'll see volatility. Nobody thinks you're stupid for selling. We're going to go in and take advantage of those air pockets and buy on any dips. And I do think that Brian's theme is right, that the market should be higher.
Both of you guys are mentioning volatility. Steph, I'm going to come back over to you. Do you see volatility, at least in the near term? I mean, it seems right now, after the cuts, the market sold off a bit. People seem to need to digest the fact that the Fed actually cut 50 basis points. And today, everybody seems on board with the idea that not only are we going to get we got a 50 basis point cut, but we might get 50 basis points more of cuts before the end of the year.
Well, we have seen volatility, Frank. Remember, just 2 weeks ago, we were down 4%, and then the following week, we gained 4% because we started to speculate that the Fed was going to go 50 basis points. And also because the economic data, while it was strong, inflation was coming down, and the job market it's softening a little bit. But again, today's initial jobless claims are very encouraging. So, I think the volatility will stay, at least until the elections, because there's so many moving parts. But at the end of the day, when rates come down, the multiple that you're willing to pay actually goes higher. And so I can see what Brian Belsky is doing here. I don't know if 9% from here is really achievable, just because we've already gained so much this year. We're up 17% on the S&P. The long-term total return average for the S&P 500 is 7.7%. So we've had a heck of a good year, a heck of a good 2 years. So I don't know if it's not up 9% from here, but yes, to your point or to your question, volatility is likely here for a bit of time. We get through the elections. I think it's Katie bar the door in terms of where we could go. It's going to be higher. And it'll all depend on really where earnings are coming out and actually where earnings guidance is going to come. I would just say one thing. Bank of America did a survey of fund flows, and it showed that the positioning for investors is really very defensive. Staples and utilities, REITs. I get utilities and REITs as rates come down. I also get utilities because it's part of that power grid, energy, electrification theme. But staples, I think, are really a place where you want to take some profits and put it elsewhere into some of the sectors like financials, like industrials, where they will benefit from the better growth.
Well, Steph, let me ask you, where do you see that volatility coming in between now and the election? That election's about 6 weeks away from now. We got a lot of certainty from Jay Powell that we're on the path of a rate cutting cycle. What do you think shakes up the market? Because, we got a very benign initial jobless claims today. Is there something else coming up, whether it be PCE, CPI? What's the thing that you think shakes the market up?
No, I think it's really tied to the elections. If you get a sweep on either side from either party, I don't think the markets are going to like that. If you get a split Congress, then that's gridlock, and the markets like that. They don't like uncertainty. Uncertainty would be a sweep. And so as we get closer and we get more and we see what the polls are doing, then we're going to have to pay attention. But that's where I think the volatility comes from. I do not think it's going to come from anything tied to earnings or even inflation for that matter.
All right, we're going to go with some committee moves right now. Kevin, you are making some moves in this market. One in the tech space, actually. Kind of give us the thesis on why you made this move now after the rate cuts.
Well, very old school tech. So when we're talking about multiples and we were talking about Brian's overall thesis, I'm coming into a position that's trading 21 times forward earnings. So this is more of an investment than a trade. But we added to IBM. IBM's a stock that was left for dead for almost a decade, Frank. They had tried to reinvent themselves so many times unsuccessfully, tripping over one roadblock after another. But I think they're starting to get it right with AI. Watson X, Watson AI, Red Hat, these are all things that are beginning to monetize correctly for IBM. But this is a position that we like the dividend, 3.12%, not big in share buybacks, not huge on dividend growth. But if they can catch that AI momentum and actually monetize it, we feel like this can be a new IBM, and we mean it this time.
All right, so you're saying if they can catch that momentum, what about the consulting business? I mean, it's soft. They guided that it's going to continue to be soft. Worried about that at all? Also, they also said they're going to take, I believe, a $2.7 billion charge related to a pension. I'm not going to get into the weeds in that. But worried about that here in the current quarter?
No, I think that that was kind of baked into it last. In fact, the last earnings were even better than we expected because we were sort of expecting that to be baked in. They'd been pretty lousy 2 quarters ago. The last number impressed me on top and bottom and pretty much even under any little asterisk that you can look at. So this isn't something that you're going to see. It's not NVIDIA that's going to double every day, but I think you can build a position here. And if management does things correctly, this can be a stock for the next 3 to 5 years that does really well.
All right, shares up 30% year to date, but can see down more than 1% today. Steph, you also own IBM. What do you think about Kev's decision to kind of jump in for some more IBM after the cut?
Yeah, I mean, I think that the management has done a terrific job in transformation of this company. This company has gone into more higher growth businesses and software services, and consulting isn't a high growth business. But to Kevin's point, they actually have done very well on execution, much better than people expected. Last quarter, we thought that consulting was going to be negative, and it actually was up 2.5%, 3%. So they're doing a very good job. They're taking market share. That's good. Software is being driven by Red Hat, by cloud, by AI, by data center, and that's all the places where you want to see them investing. And I do think that the free cash flow story is so underappreciated. Last quarter, they guided for this year to be 12 billion plus. I think next year they can do something closer to 13.5 billion. People don't give them credit for the free cash flow they are generating. And then eventually, by the way, they're paying down debt. That's good. And then eventually you're going to see buybacks and increases of dividends next year. That's next year's story, I think.
All right, again, IBM shares down just about 1 1/3 of 1%. All right, time now to bring in senior economics reporter Steve Liesman, also amateur Latin teacher. Steve, good to see you again today. I mean, let's just talk it out. You hit us with the Latin yesterday. Surprised to see 50 basis points. The dot plot guide us to 50 basis points more of cuts before the end of the year. What is your take?
Well, here's the thing. You would think having an English degree would not be very useful for being a Fed reporter, but what are we doing today, Frank? We're trying to understand the meaning of the word recalibrating when it comes to monetary policy. So I bring you a few suggestions, none of which are all right and none of which are mutually exclusive. But here's what we're doing, what the Fed might be thinking about when he talks about recalibrating policy. One, from inflation concerns to worry about employment. Two, from restrictive policy to neutral. And three, to a policy that may ultimately be less data dependent. Because why? Because we're recalibrating. We're not necessarily going from, based upon the economy. We need to recalibrate to a place that's more neutral. Let me go through now, if you don't mind, where the probabilities are right now. 59% probability for a 25 in November. By the way, the rest of that probability is for a 50, but you get that 50 come December, 89% for a 50. So the market still thinks 50s are on the table. And now for the first time, we're adding January. One more thing I want to show you, which is the longer term projections in the futures market. One more full screen here, which is we're at 488. We go down to 415 by Christmas. By, let's say, tax day or the Ides of March, we'll be at 365. And then come, what do you want to call it? The September equinox, we should be at neutral. That's the projection right now in the market, Frank. That's my understanding of recalibrating. We're going down to neutral.
All right, so Steve, as we're recalibrating, give us a sense. So I was asking the committee just a second ago, what matters when it comes to economic reports, or does anything matter? We just saw your full screen, the Fed, quote unquote, less data dependent, but next week we get a second revision on GDP, we get PCE. Is that still meaningful? Do you see that still being meaningful to the Fed? And we're going to ask the traders if it's meaningful to the market.
So that's a good question, Frank. And I think what's happening is when I say less data dependent, it doesn't mean they're not data dependent. I think if you follow the trade here, we have been trading the CPI out to 1/100th of a basis point, even 1,000th of a basis point. If it's 0.17, it matters if it's not, 0.22. That's kind of crazy. I think the band on that has now expanded. What we're doing is we're reducing interest rates right now because of the progress in inflation so far, because of the concern over the employment market. I think the Fed will be more sensitive to somewhat, more minute changes in employment than it will be to inflation, unless you get to a point, Frank, where there's concern inflation is rekindling.
Steve, we got one question for you from Jim Leventhal.
Hey, Steve, it's Jimmy. Listen, we all know you're the senior economist, and you often, when you're given a market question, you punt it right back and say, well, you guys are the market guys. But having said that, we know each other. What would you say to me, if I were to say to you, as I am, that after 2.5 years, maybe market participants can stop thinking about the Fed? We know the direction they're going. I don't think a guy like me needs to wake up in the morning and go to sleep at night thinking about the rounding error on CPI or PCE or 25 versus 50. What's your response? So
I think you can think less about the Fed, Jim. How's that? I think the deal is that
I'll take that. Believe me.
Okay, and here's how I'd explain that, which is, in general, as a guy advising people or you're making your own decisions at home, you have to have a view on the Fed. And I think recalibration is kind of similar to normalization, also similar to a paradigm shift. You can probably invest that paradigm shift if you believe inflation's under control and the Fed is heading down to this neutral standpoint. If that's true, then I would think about the valuation of stocks. Guys, if you could put that chart up one more time, in and around that 3% mark of September 2025. Roughly, remember, 2.9 is the Fed's neutral rate. So I think a year from now, we should be somewhere around 200, 250. And Jim, I know you think in these big, broad terms. If it's 350 or 250, I don't think you care that much. But in general, 200 lower is a big deal for all investment decisions. And I think you could probably start to bank on that over time with some risk tolerance around that number, and then make your decisions bottom up based on the companies, based on the instrument.
All right, senior economics reporter Steve Liesman, always great to see you. Thank you very much.
Thanks,
DoubleLine CEO Jeffrey Gundlach also sounding the alarm on a recession. Here's what he told our Scott Wapner immediately following yesterday's Fed decision and news conference.
The level of debt on the consumer is very high. And so I expect to see weaker economic data in the coming reports. I still think there's a good shot that the history books will say September of 24 was the start of a recession.
Again, that's Jeff Gundlach talking to our Scott Wapner yesterday. Steph, I'm going to come over to you. What do you make of what Gundlach had to say about the risk of a recession?
I mean, I just don't see it, not right now. As I mentioned before, we're running at around 2.5 to 3% in GDP. I think everybody was very surprised at the retail sales number. This is a consumer that just won't quit. And if you listen to what the banks had to say last week at the several conferences, every single company said the consumer was in decent shape. Even as like Ally Financial is talking about credit issues creeping a little bit higher. But I would also point out, a lot of companies talked about delinquency rates at the banks, and you're running at about 2%. So in 2019, you were running 2.5%. So everybody that says that delinquencies are on the rise, they're exploding higher, well, actually, they're leveling off. And as I said, most of the commentary from the companies said that the consumer is fine. Then you add in this manufacturing renaissance that we're having in onshoring and reshoring, power grid, electrification. That's really very, very powerful. And I think that is actually one of the reasons why we saw better than expected Empire and Philly Fed manufacturing series that came in a little bit better than expected. Nothing heroic, but better than feared, and a little bit of growth, and that's great. And then when you throw in housing is going to recover. You get mortgage rates of under 6%, there is enormous pent-up demand. There are 5 million homes short in this country, and the builders just don't want to build. So the point being is the housing sector, if you do get a reignition of that part of the economy, that's a multiplier effect. When you buy a home, you got to buy stuff and put it inside that home. You got to buy stuff around the home, outside the home, and then you have to buy a car to get from the home to and from where you're going. And so, in fact, there's a high correlation between auto sales and home sales. And permits this week were better than expected, and that's a leading indicator. And again, we have a long way to go. And rates are still too high to see massive explosion of growth, but there is that pent-up demand. And so that's why I don't see recession anytime soon, especially if the consumer is going to be okay. And that goes back to wages and jobs, which are just fine.
All right, you know what, Steph, we're going to be talking about housing later in the show, but right now, straight ahead, playing the banks after that big Fed rate cut. We're going to tell you how the committee's position in that trade, plus we're nearing session highs. The Dow's up over 500 points. We are all over this rally. Halftime's back in just 2 minutes. As we mentioned, the Dow more than 500 points higher. The S&P also hitting an intraday high, and we are back here on halftime. As we said, stocks are in rally mode, led by gains in big tech, but financials, they're also in the green, up 1%. Following the Fed's first rate cut in more than 4 years, our Leslie Picker is following that story for us today. Leslie, good afternoon. Good to see you.
Hey, good afternoon, Frank. Good to see you. Banks higher on the news of that first rate cut, even though there is some complexity as to how rate cuts actually affect the industry. In the near term, rate cuts can actually be a net negative for them. Loan yields reprice downward more quickly than deposit costs. That can pressure margins, and the first few cuts tend to do little to alleviate asset risk. Only when the easing becomes more impactful over the long run will things like commercial real estate loan refinancing stabilize, according to Moody's. However, in the long run, as deposit costs do decline and capital markets volumes rebound, the environment should become much more supportive, barring any recession. Historically, investors have been willing to look past that short-term noise. According to Wells Fargo research, rate cuts with no recession have resulted in bank stocks rallying in the first 3 months following that rate cut, which of course is reflected in today's trading as well, Frank.
All right, our Leslie Picker, live from the NASDAQ. Leslie, thank you very much. Let's see where the committee stands on the banks right now. Steph, I'm going to come over to you. Everybody has financials ownership, but Steph, your holdings, Bank of America, Morgan Stanley, Schwab, and Truist. What do you make of this idea of rate cuts and the impact on financials?
Yeah, I mean, rate cuts with growth, Frank, is a good thing for banks. You have a steeper yield curve, and that will help net interest income and net interest margins. Capital markets are recovering. M&A pipelines are expanding. Higher asset prices should help wealth management and net new assets. And Basel III endgame, whenever we get the final numbers, will show and expect lower capital levels. And many companies at the banks last week at these conferences, they did talk about buybacks are coming. as soon as they know what the capital levels are, Bank of America in particular. So I think with these stocks trading at 1 times book, 1.5 times book, they're very attractive. I own Bank of America and Truist mainly for net interest income and net interest margin expansion. I own Morgan Stanley for the M&A, for capital markets, for wealth management, as well as Schwab, and then American Express with the consumer doing well, with corporate business now above 2019 levels. That's very encouraging. The valuation has expanded a little bit, but they're still the number 1 player in the industry. So I think there's lots to be had here in this sector. I'm overweight by a mile.
Kev, coming over to you. You also own American Express, Visa, 2 payment companies that hit highs in recent days. What's your view on the idea of the rate cut impact on these names in particular? You've got to remember the consumer is very much stretched when it comes to credit card debt.
Yeah, well, clearly, Stephanie and I don't think we're in store for a recession in the short term. American Express has a very high-end consumer. Like, they are very discriminatory into who they bring in. And Visa is a fintech company. They're not exposed to defaults or delinquencies or non-payments. So we think that the consumer is still going to spend, especially on the high end. Within the traditional space, we have Goldman and JP Morgan, again, for all the facets that allow us to participate in M&A and IPOs should they ever come back into existence.
Jim, what about you? Group JP Morgan, also BlackRock.
I'm very overweight financials. If we go to BlackRock, I mean, Stephanie was pointing out asset management. This is a pretty simple story to understand. Equities are up, bonds are up, meaning the assets under management at BlackRock are up. It's no surprise that the stock has returned 36% in a year. But, the key thing that Kevin's saying, Stephanie is saying, and I'm saying is we just don't see a recession on the horizon. If there were, that would be something that would worry me about a Citigroup with a high amount of credit card business. But, as we've been talking about, Fed has cut. Rates are going to start coming down. That pressure on the consumer is going to ease. And so this is a time to own something like Citigroup, which trades at around 70% of tangible book value. I see absolutely no reason that it shouldn't trade at book value, which would imply 50% from here.
All right, again, financials up 1% today as a sector. Taking a look at the markets right now, you can see the Dow is up over 555 points, 555 exactly right now. The S&P also hitting an intraday high. We are in rally mode. Time now for our calls of the day. We're going to start things off with Elanco, downgraded to equal weight at Morgan Stanley. Steph, you own this one.
I do. The stock is up 20% from the recent lows, and so I guess the analyst is taking some money off the table, but it's still down 3% year to date. Trades at 13.8 times. Forward estimates, the long-term average is about 21 times. This company has 3 products in their pipeline this year and 1 next year that I think is going to drive better revenues, better growth, better and more consistency. I think execution is key. It's been wobbly as of late, but I think they're going to be able to capitalize on these new products. Costs are coming down. And don't forget, Frank, we spend about $154 billion a year on pet stuff. So the trends are there, and I like it very much.
Yeah, I'm a purebred Cocker Spaniel. I spent quite a bit of money myself there, Steph. Next up, Casey's General Store is downgraded to underweight at JP Morgan. Jim, you own this one.
Yeah, I own it. I'm not worried about this call at all. It doesn't make me want to sell the stock. The analyst admits that he's been on the sidelines as it's gone up, 32% over the last year, 25% per annum over the last 3 years. I'm not taking a shot at him. He was neutral that whole time. Now he's saying this is a valuation call. That's fine. I mean, beauty is in the eye of the beholder. But if you're neutral and you want to take the stock down because of a valuation call, the only place to go is underweight. So a lot of times when you see an underweight call, that means there's something fatally wrong with the stock. That is not the case here. And regarding valuation, I mean, there's plenty of stocks in the retail space that sell at a low to mid 20s multiple. I can think of TJX just as an example. This is a company, Casey's, however, that's executing very well on a long-term strategic plan that includes acquisitions that it's making along the way. I feel very comfortable holding this.
All right, Gordon Haskett out with a bullish note on GE Vernova, calling it a standout spinoff, noting it's the best stock in the S&P 500 over the past month. Steph, back over to you. You own this one.
Yeah, it's been up. It's about up 58% since they were spun off from GE. Frank, we've talked about this a lot. Spins work. GE Healthcare has also done very nicely as well. And Larry Culp has really created huge value by spinning off these properties. This is all about electrification, power, grid, and that theme. And you know I'm very big on that theme. The company has margin expansion opportunities as well. And so everybody hated this division when it was part of GE, and now they actually appreciate what they are and the management team and the execution. So I still like it very much, even though it's up quite a bit.
All right, one more. We got Spotify. Its price target raised to a street high of 510 at Pivotal Research. Kevin, this one's you. You own it.
Yeah, I like this call. We have it in our new growth ETF, QDevo. This is a company going from a great business, from a great product to a great business. Gross margins were up 30%. Expenses were down 16%. They have $40 million in record cash flows, and they have $5.4 billion just sitting in cash at the moment. So they're reducing their debt, they're increasing their subscriber base, they're increasing their margins, hitting at all cylinders. We like this stock and we like this call.
You can see shares are up just about 6% right now. Straight ahead here on halftime, Mike Santoli standing by with his midday word as the stocks, they hit fresh record highs. Halftime back right after this. Welcome back to halftime. Taking a look at the NASDAQ, up 2.8%. We're in rally mode. The S&P and the Dow hitting intraday highs. A number of chip names pushed the NASDAQ higher along with Tesla. NVIDIA also up 5%. Hard to believe we're not even talking about that one. Welcome back. We're now joined by senior market commentator Mike Santoli. He joins us with his midday word. Mike, you can't say recalibrate. That's the one word you can't use.
Yeah, we can leave that aside. We got our money's worth out of it. Obviously, the market is willing to absorb the general message, though, that what the Fed did yesterday is intended to preserve a soft landing that seems likely, as opposed to try and resuscitate an economy that's in trouble. Everything is feeding together. It's a very broad rally today. You mentioned the NASDAQ up almost 3%. It's sort of a reprieve for the mega caps, which have, I think, really surrendered leadership to the rest of the market for the most part. The NASDAQ 100 is actually just kind of flattish on a quarter-to-date basis, and the rest of the market's doing fine. You know, we're also only about 1% higher on the S&P 500 than we were at the prior peak, which was July 16th. So if you think of it that way, it's kind of 2 months of sideways in terms of figuring out, is the economy going to slow faster than the Fed can give us a little bit of help on rates, and credit is held together very well. So it's a very happy story. There's a little bit of an offset to that. It's probably the initial valuation we're talking about here. The market already was on a little bit of a comeback roll in the last 8 days or so. So it's not as if everybody was in a defensive crouch and now that they're having a big relief rally, it's just piled on top of gains we already had.
You know, Mike, I know the traders have questions for you, but very quickly, surprised at all to see tech leadership today as opposed to a cyclical sector?
I wouldn't say surprised. I think it is a lot of like, we're buying everything, and they were the farthest below their recent highs in terms of the major groups. So we're trying it. I have my eye on NVIDIA. It's not yet made a higher high than the prior peak, so it's definitely still in this sideways mode. So I guess I'm going to reserve judgment as to whether this is, you know, a change in character of this market that's been moving away from tech until we get a few more days of follow through.
Mike, let me dig a little deeper. I mean, you're clear about sideways, S&P 500, NASDAQ. I hear you on that. I'm trying to think if the rally in small caps and the equal weight S&P 500 is for real. You know, spoiler alert, I think it's for real, but how many times have you heard me say that?
There's definitely more room for it to kind of get a little more air under those indexes before you have to worry about it. I would say for real in terms of the equal weight. I mean, small caps, who knows if that's what it is. It's going to go along with the banks. They're going to trade in that direction, I think. But again, I think we are still going to have to keep the overall economic data on a little bit of a longer leash than yesterday, but you still have to watch it. I think the difference is if you get disappointing economic numbers, the Fed just showed you they were willing to go 50 when they thought the economy was okay. They're going to be there. And so the buffer from the Fed is in there. So in theory, cyclical should hang in.
All right. Straight ahead here on halftime. Hold Gold. Double Line's Jeff Gunlock making the case for that commodity. We're going to play the exclusive sound. Plus, Kevin Simpson just made a new move in the space. We're going to break down his trade. Halftime returns right after the Diana Olick in Washington with the news alert. Diana.
Well, Frank, we just got today's average rate on the 30-year fixed mortgage from Mortgage News Daily, and it came in at 6.17%, an increase of 2 basis points from yesterday. And yesterday actually saw a 4 basis point increase. So we're up 6 basis points on the 30-year fix since the Fed cut rates. And I am saying that right, up. So why are mortgage rates increasing? Well, because mortgage rates don't exactly follow the Fed funds rate. They follow loosely the yield on the 10-year Treasury. but they've been pricing in this Fed cut for more than a month now. So we've seen rates come down for over a month. They've also been reacting to better economic data and to economic reports showing that inflation is easing. So they have come down sharply since July 1st. In fact, on July 1st, the average on the 30-year fix was 7.14%. And just for a home buyer out there, if you were buying a $400,000 home with 20% down on a 30-year fixed in July versus today, you're paying $210 less per month today than you were in July. Frank?
All right, Diana Olick. Diana, thank you very much. Turning it over to you guys. I mean, just looking at that right there, we saw mortgage rates, just bump up very slightly, just 2 basis points. But just how are you viewing the housing market right now with the idea that we're in a rate cutting cycle?
Well, first off, I mean, mortgage rates are down significantly from their high. I think it was about 7.7% on the 30-year about a year and a half ago. So mortgage rates are down, and eventually that's going to stimulate a housing recovery. Obviously, there's a corollary problem to this, which is that housing prices are too high. So I don't think that it's going to be off to the races in terms of the housing market. Having said all of that, we've got to acknowledge that the housing market has pretty much been in a recession for a while now. So any sort of growth is going to be welcome, and it's already been anticipated, by the way, by the home builders to a large degree, and some of the home improvement companies to a slightly lesser degree.
Yeah, you mentioned that home builders hitting a record high this week. Steph, coming over to you, you own D.R. Horton. What do you make of what we're seeing in the mortgage market and the fact that it just ticked up very slightly, but as Jim pointed out, well off of its highs?
Yeah, I mean, mortgage rates have come down quite a bit. In October of last year, they hit 8%, 30-year fixed, very, very briefly, but now it's 6.1%. You can see why there is a little bit more demand. I mentioned the supply-demand dynamics. It's a very tight market. What I think is even more interesting, though, is that mortgage applications have actually increased 6 out of the last 7 weeks. That's very encouraging. That's a leading indicator. Rates are the lowest since February of 2023. U.S. household net worth is now at a new record, and that's tied to home prices that Jim was talking about, but also tied to stock prices. So I think that a lot of that is very powerful for the consumer. In the meantime, the home builders are trading at 12, 13 times forward estimates. They're very disciplined in terms of the supply. They don't want to build. They'd rather buy back their stock. But their commentary has been very encouraging throughout the earnings season, throughout guidance, and margins are expanding, which means they're not actually giving out discounts as much as they had been. So I like the group very much. I think Home Depot can play catch up more so than, to the home builders. But I still like the home builders very much.
All right, D.R. Horton right now, those shares up just over 1%. Coming up next on Halftime, we're trading gold's record run as Kevin Simpson makes a new move in that space. Halftime's back right after this.
On the street, CNBC.
I continue to hold gold, and I would dollar cost average into it at these prices. I mean, we're close to the highs of all time. And so, but the setbacks are very small. It's symptomatic of a market that is in accumulation mode. And I think that the path of least resistance for gold continues to be up.
And that was Double Line CEO Jeff Gundlach sitting down exclusively with our Scott Wapner yesterday on Closing Bell. So Gundlach likes gold, and Kevin, you just actually made a move in that space as well.
We did, Frank. We added to our Freeport-McMoRan position. I know Stephanie owns this as well. It's a little bit more of a copper play than a pure gold play. And we're thinking of this longer term. We're not investing in this because we're thinking there'll be a China reopening or everyone's going to have an electric car. We think about this as an incredible business model that knows how to utilize cash flow. Now, they only pay a little bit under a 1% dividend, so not huge, but it's been increasing at a 25% clip on average for the past 5 years. And what we like most about this company is the way they've handled their debt. In 2016, they had $20 billion in debt. They've whittled that down to $4 billion this year in 2024. They know how to manage their business, and there will be at some point a much stronger demand for copper. So this is an investment for us, not a trade, Frank.
Steph, you also own Freeport-McMoRan. What do you make of the stock and also just Jeff Gundlach's call there on gold?
Well, it's been a frustrating stock, but if you can get the number one player in the industry trading at 6.5 times EBITDA, you take that all day long. So I totally agree with Kevin. 12% of their business is gold, so the rest is copper. So that's really why I own it. But the gold piece definitely does smooth out things. Gold is a diversification tool, and I don't have a problem owning it. I would just rather own a company that has exposure to it versus the pure commodity itself.
All right, looking at Freeport-McMoRan today, shares up just over 3.5%. Stay with us. Final trades. They're coming up on Halftime. Steph, you're up first.
Target, I think it was one of the winners during retail season, along with Walmart, Costco, and Amazon. They have the traffic, they have the same store sales, and I love the new CFO hire that they announced today. He worked under Hugh Johnson at Pepsi for 25 years.
Kevin.
Home Depot, we'll think they'll be a tremendous beneficiary of lower rates. I buy it on pullbacks, 2.3% dividend, growing at a 10% clip.
Jim, jumping on the bandwagon, it looks like.
I am the bandwagon, okay? IJR, small cap, profitable small cap. I don't know what you're talking about, Frank. Go back to the start of the show if you missed the reasons why.
A lot of people talking about small caps today. That's going to do it for halftime. Remember, the Dow and the S&P trading very close to records, actually intraday records, and the exchange starts right now.